Hi everyone, my name is Mark Quinn. I'm a UK tax advisor and chartered financial planner living and working in Portugal, and I help UK nationals relocate to Portugal and plan their tax and financial affairs accordingly. In this video I'm going to look at the key changes that the Chancellor of the Exchequer made on the 30th of October that affect people holding UK and international pensions that are living in Portugal with or without non-habitual resident status. A key change of the UK budget on the 30th of October was a fundamental shift in the treatment of UK pensions. Now, as the rule stands at the moment, UK pensions, or all recognised pensions for that matter, so overseas pension schemes such as qualifying recognised overseas pension schemes, QROPs, or qualifying non-UK pension schemes, QNUPs, they're also outside the scope of a UK inheritance tax charge if planned correctly. Now, this is going to change. So in the budget, the Chancellor announced that with effect from April 2027, UK pensions and all pensions are going to be brought in the scope of inheritance tax charge. Now, this is a fundamental shift and has an impact on the planning we will be doing for clients going forward. Because up until this point, and indeed up until April 27, our general advice is that people should retain as much money in pension schemes as possible and fund their lifestyle, so take income and withdrawals from elsewhere in their assets. So if you had, for example, ISAs, cash in the bank, investment portfolios, general investment accounts, the general planning point was to eat into those funds first before touching the pension scheme, and that was simply because pension schemes are always outside the IHT tax charge. Now, if the pension scheme is now going to be brought within the scope of inheritance tax, it loses one of the key features of pension planning. In addition, this impacts in relation to the change to inheritance tax and how that's going to be determined from April next year, because those of you that will be considered non-long-term residents, so you've been clear of the UK tax net, you've been outside of the UK for 10 years or more, you won't have an inheritance tax charge anymore. You won't have that liability to UK inheritance tax, with the exception of UK-based assets. Now, a UK pension scheme will still be treated as a UK-based asset and therefore be subject to the 40% tax charge. So the obvious planning angle there is to remove the UK pension scheme from the UK system. And you can do that in one of several ways. You could transfer to a QROP, so a qualifying recognised overseas pension scheme. However, again in the budget, they introduced a 25% tax charge to transfers to QROPs. So this has become a lot less attractive. The other planning angle would be to withdraw the pension scheme in full at your marginal tax rates. Now, this is going to be quite expensive for you if you don't qualify for the non-habitual residence scheme, which gives you 10 years of tax efficient living here. But if you do qualify for non-habitual residence and you either have the 0% or 10% tax rate, then you could draw down fully the pension scheme, remove it from the UK tax net, pay the 10% tax rate or hopefully 0%, and that will be the extent of your liability, because under the tax treaty the UK won't have a taxing right on any income paid from a UK-based pension scheme. So you've cleared it from the UK tax net, you've saved your estate 40% tax, and at the same time you've taken advantage of that 10-year window that you can use to extract money tax efficiently from pension schemes. There is also a potential double tax charge with pension schemes and death benefits, because if UK pension schemes are now going to be brought into the scope of IHT's tax charge at 40%, there may also be income tax charged on the beneficiaries at their marginal rate when they receive the proceeds if you die after age 75. So in worst case scenario, your beneficiaries have a 40% inheritance tax charge, and they then pay an income tax charge up to 45%, so it can be quite painful. So we're encouraging people to look at their affairs as a whole now, reassess if what they're doing is still tax efficient, and effective in light of the budget changes introduced on the 30th of October. Now, as I stress in all my videos, none of this is advice, it's just information only, but just gives you some pointers and a few planning ideas that you really need to talk through in detail with your advisor, your financial advisor and tax advisor. And if you wanted to reach out to me to look at your affairs and do a free assessment and review of your situation, and if anything can be improved, it will be a pleasure to do so. Thank you.